Hello, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving deep into a topic that I think is one of the most underrated, yet most important aspects of trading and investing. It's not your chart patterns, it's not your technical indicators, it's not even your fundamental analysis skills. It's something far more personal and honestly, far more dangerous if you ignore it. I'm talking about you. More specifically, your own mind. That's right. You might not realize it, but in the markets, your biggest opponent is often not the market itself. It's your emotions, your instincts, and your built in biases. Today's episode is going to be a comprehensive guide to behavioral finance and biases, what they are, how they show up in your trading, the damage they can cause, and most importantly, how to manage them so they don't wreck your account. And I'll also be sharing practical investor emotion management tips that you can start using right after this episode, along with tools and resources that can give you a serious edge in staying disciplined. So, if you've ever sold too early, held too long, or followed the herd into a bad trade, stay tuned because we're going to unpack it all. What is behavioral finance? Let's start with the basics. Behavioral finance is a field that blends psychology with economics to explain why investors often make decisions that are, well, irrational. Classical finance theory assumes investors are perfectly rational, that they always act in their own best interest and process all available information objectively. But if you've spent even 5 minutes in the real markets, you know that's not true. People buy because they feel excited. They sell because they feel scared. They chase hype. They cling to losing positions out of stubbornness. Behavioral finance says, let's stop pretending humans are robots. Let's actually study how emotions and cognitive shortcuts, also called heuristics, influence money decisions. Nobel Prize. Winning research from Daniel Kahneman and Amos Tversky showed that these biases aren't random accidents. They're consistent, predictable patterns. And in the markets, those patterns can be expensive. The hidden cost of emotional investing. Let me paint you a picture. You find a perfect trade setup. The trend is clear, the fundamentals make sense, and you've got a good risk to reward ratio. You enter confidently. Then the market dips a little. Fear starts creeping in. Your heart rate goes up. Your palms sweat. You panic sell, locking in a small loss, just in time to watch the price bounce back and soar exactly like you predicted. Sound familiar? That's emotional investing. And here's the thing, it doesn't just cost you one trade. Over time, it leads to overtrading, constantly jumping in and out without a plan, poor risk reward, cutting winners too soon and letting losers run, burnout because you're always stressed and second guessing, long-term underperformance because emotions make you miss the big moves. The truth is, the market is hard enough without fighting against yourself. Common trading biases and how to avoid them. Now, let's break down the common trading biases that cause most of these emotional mistakes and how you can avoid them. 1. Confirmation bias. This is when you actively seek out information that supports your existing belief and ignore anything that contradicts it. Example, you believe a certain stock will skyrocket. So you only read bullish analyst reports and you dismiss negative earnings data as temporary noise. How to avoid it. Deliberately look for opposing viewpoints. Set objective entry and exit rules before you place a trade. Use multiple sources for research, not just one. 2. Loss aversion. This is one of the strongest biases in finance. Research shows that the pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. Example, you refuse to close a losing trade because you don't want to lock in the loss, even though the fundamentals have deteriorated. How to avoid it. Use stop-loss orders and stick to them. Focus on the bigger picture. One trade doesn't define your performance. Remember that preserving capital matters more than protecting your ego. 3. Overconfidence bias. This happens when you overestimate your skill, your knowledge, or your control over outcomes. Example, you have a winning streak and start increasing your position sizes dramatically, ignoring your normal risk rules. How to avoid it. Keep a trading journal to see whether your wins come from skill or luck. Stick to consistent position sizing. Review losing trades just as carefully as winning ones. 4. Herd mentality. This is when you follow the crowd because you assume the majority must be right. Example, buying into a hot stock or cryptocurrency just because it's trending on social media. How to avoid it? Ask yourself, would I take this trade if I hadn't seen it online? Base your trades on independent analysis. Avoid chasing parabolic moves. 5. Anchoring bias. This is when you fixate on an arbitrary number or reference point and base your decisions on it. Example, believing a stock must return to its previous high, even though market conditions have changed. How to avoid it? Reassess your trades regularly with updated information. Accept that past prices don't guarantee future value. Avoid should thinking. The market doesn't owe you anything. Investor emotion management tips. All right, now that we know the biases, how do we fight them? Here are some practical investor emotion management tips that can help you trade more rationally. Tip 1. Create a written trading plan. Outline your entry and exit rules, position sizing, risk per trade, market conditions where you won't trade. When emotions spike, you'll have a rulebook to fall back on. Tip 2. Use risk management tools. Stop loss and take profit orders remove split-second decision-making pressure. Risk only 1 to 2% of your capital per trade. Diversify so one bad trade doesn't crush you. Tip 3. Keep a trading journal. Record your reason for entering a trade, emotional state at the time, result versus expectation. This reveals patterns in your behavior and helps you correct them. Tip 4. Schedule downtime. Constantly staring at the charts can make you trigger happy. Set defined trading hours and take regular breaks. Tip 5. Keep learning. The more confident you are in your knowledge, the less likely you are to act out of panic. This is where educational resources really shine. The role of technology in reducing bias. Even disciplined traders benefit from the right tools. A fast, intuitive, and reliable trading platform can help you execute your plan without hesitation and access the data you need without distractions. That's why I always recommend checking out crystalballmarkets.com. It's a world-class, cutting-edge, user-friendly trading platform app designed to give traders both speed and clarity. Whether you're a complete beginner or a seasoned pro, having the right platform can seriously reduce those emotional mistakes. Visit crystalballmarkets.com today and see the difference for yourself. Learning on the go. And here's something else that's been a game changer for me: staying educated while I'm away from the screens. If you're looking for beginner-friendly trading, investing, macro, and financial markets podcasts, I highly recommend Crystal Ball Markets podcasts on our ss.com. They're easy to follow, packed with insights, and perfect for commuting or downtime. Go listen now. Your trading brain will thank you. Closing thoughts. Behavioral finance teaches us a humbling truth. The market might be unpredictable, but your own behavior doesn't have to be. By recognizing your biases, applying disciplined emotion management techniques, and using the right tools, you can dramatically improve your odds of success. So remember, identify your blind spots, follow your trading plan, keep learning and upgrading your tools. The best traders aren't just good at predicting the market, they're great at managing themselves. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and as always, trade smart, manage your risk, and never stop learning.